It is now time to talk about seed investing. With venture and later stage activity in the doldrums, the competition in seed stage investing has never been hotter. But is the seed space set for a similar downturn? Here to discuss are some of the world's most active early stage investors. Please give a warm welcome to your moderator, Grit Daily's Jordan French, and your speakers, General Partner at the Fund, Jenny Fielding, Managing Partner at MS&AD Ventures, Jon Soberg, and Partner at Inovia, Magaly Charbonneau. Here they are.
Wow, thanks, Jay. Wow. I've been instructed to close this door, but leave it slightly ajar, which I have an audience that is my witness that I've done that appropriately, so success on that point. Big round of applause for yourselves for joining us here at Collision. Team Toronto. Who here's from Canada? Yeah, love it. Love this state. Just kidding. No, we're Americans and we say these kind of things. Make mistakes all the time. Speaking of mistakes, probably a lot will be made in the next few months, at least potentially. That's my prediction from an investment standpoint by VCs. By design, often they'll lose money, which we'll talk about a little bit here. But if you would join me in welcoming Jenny Fielding from the Fund. Big round of applause for Jenny. You know where to find her. We wrote about her. Jon Soberg, I've had on stage, MS&AD Ventures. Good to see you. And Magaly Charbonneau, Inovia Capital. She's our local, coming in from Montreal. Any Montrealites? We have a few, Magaly. But weighing on everyone's minds, Jenny. We've seen markets, equity markets, take a steep downturn. Interest rates are up across the board. Inflation is somewhat raging. A lot of us are worried out there. A lot of us as founders, especially if we're late stage and we don't have a lot of runway. But your take, Jenny, to quell our nerves.
Well, thank you, Jordan. I'm actually an optimist. I think to be a venture capitalist is to be an optimist and to see, the good things in the world. So I don't think that, the next 18 months are going to be, the boom years. But I also think that there's a lot of good fundamentals. So I think if you're running, a good business, if you have profitability, in your purview, if you've been conservative with cash, I think you've got a great trajectory. So I'm more of the optimist.
And speaking of trajectories, we know this about Inovia. If you guys don't know, they issue a monthly or quarterly issuance to all their portfolio companies. And we're going to pull back that curtain now. Meg, what are you saying to your portfolio companies that you can share with the audience here that they might not otherwise have revealed to them based off the intel that you guys have?
Can you hear me with this microphone? Okay.
Yes.
So what we're telling our portfolio companies right now that raised money during the mini bubble we just had from March 2020 until now is to make sure that the fundamentals are working, that they're growing into this high valuation that they potentially got during the bubble, and to really be conscious of the ARR burn ratio. So you want to make sure that you can grow into this valuation so you have enough runway to grow into this high valuation before you raise your next round. And I'm like Jenny, we're optimistic. Inovia just announced their Venture Fund 5, which is $325 million fund, and we need to deploy that. We're looking for always at deploying. So even if probably the next 18 months will be a little shaky, there's always money to fund great products, great teams with massive total addressable markets at the seed stage.
Well, hold the thought on the word, shaky, but yeah, big round of applause for raising that latest fund. It's now 2 billion.
We have $2 billion US under management.
Yeah, 2 billion, and just for perspective, so MS&AD, I know about 300 million that you've deployed so far, and Jenny Fielding at the fund around 45 million. AUM.
We're small but mighty.
Yeah, small but mighty. But and speaking of what's mighty, right? It's about writing checks. So just for perspective as well to share that, and I'll start right back with you, Mag. How many checks have you written in this environment, what seems like malaise, in the last, let's say, 2 months?
So the new fund is we've already deployed we have 2 companies that we've announced. One in the cybersecurity space, it's a Series A, and also another Series A in Toronto right here, a company called Signal One. And as I said, we have lots of capital to deploy, so we're not going to hold back. Our LPs are expecting us to deploy half of this fund, the rest is for reserves, in the next 3.5 years.
Well, we're listening, and we heard you say shaky earlier, Mag, and also lots of capital to deploy. So we're going to take that dissonance and unpack that. But John, on the same question.
Yep. I signed documents for an investment this morning before I came over here.
Tell us about it so I can maybe call them up.
So you can call them up. Sure, we may extend this round a little bit right now, which seems to be a common thing. No, we're still pretty active. I think we did a deal last week. We've done 70 deals in the last 3.5 years, so we're a very active fund. And I think our view is that we're going to find some great deals, and then we're seeing some of our portfolio companies extend their last rounds or keep their runways a little bit longer. That's wise, I think, in this market. But I think we are also optimists in the grand scheme of things.
And Jenny?
I mean, we write small checks, but in Q2 we've written 20 checks. So
in the last 2 months?
Q2, so for all of Q2,
yeah.
so three months. And almost 3 months. Yeah, we're active. We play at the pre-seed, and we're getting in at attractive valuations at that entry point. We're trying to buy up ownership early, and we think these companies have great trajectories, and this is an incredible time to be investing, right?
Yeah, certainly, and I think you're doing this too, Jenny, but I'll bring John right back into this. You just mentioned a term, I think it was along the lines of, re-upping, or like a static round. Can you just unpack that for the audience, John?
Yeah, I mean, I think, look, if you have to be a realist in this market. So a lot of VCs right now are kind of looking at their portfolio and saying, okay, these are the ones that are doing great. These are the ones that, we're not quite so sure about, and these are the ones that are sort of shaky. And the great ones are frankly getting term sheets from other VCs, or their internal investors are adding more capital typically to give them even more runway. We think those companies are going to some of them will dominate in the next 18 to 24 months because they're going to have enough capital to take some market share, and some other companies are just not going to have as much in terms of resources to compete.
Yeah, certainly, and John, for your purposes, Meg, it sounds like a bit of survival of the fittest. You both now mentioned the term shaky, but what I'm hearing, to repeat it back to you, Mag, is that you might see some more opportunities, not fewer, based off valuations. But your take?
What's the last?
You might see more opportunities based off valuations because of the compression that John started to tease out.
Yeah, so we're doing the same thing. Just doing an extension on the last round is quite popular right now. And some of my seed investments are also going just internal rounds for the next round. And convertible notes are starting to be a little popular because they don't want to get the round priced. So this is also going to be, I don't know if you guys have seen this in your portfolio companies that raised, that are just doing a convertible for the next one. So this is really going to happen quite a bit.
And what you mean by that, when you say they don't want to price the next round, you're referring to the investors, the VCs.
The entrepreneur. The entrepreneur they don't want to go out and have the round priced if they raised during the bubble. So they might do a convertible note until things settle down a bit and valuations go back up a little bit, so that they don't have to do a down round.
So from your point of view, the companies themselves, the entrepreneurs, they're already seeing some compression in that multiple. And let's walk through. You, John, do you want to chime in on that?
Oh, I think for sure the compression of the multiples is there. We'll see. On the VC side, it's probably a question of, how fast can you lose money right now with your existing portfolio, and but the compression is real, especially in the late stages. I think for the seed rounds, we're not seeing it quite as much. There's still, there's a lot of capital. If you're a great company that's got a really good team, you're still able to raise a really nice seed round right now, and I think that's not going to change.
Yeah, and you said not yet, Mag, and we're going to go right back to that. But Jenny, just to lay even more foundation, we're all thinking about the calculus here, right? The discounts rate, inflation is a factor. Certainly, just general multiple compression. Tides ebb and flow. If you could just walk us through some of that, to lay some of that foundation, Jenny, what are some of the key macro factors that might impact investment valuations from your standpoint?
Yeah, I mean, I think, the market is the big one, right? For us, many people who are over-indexed in tech saw, 30% of their portfolio, decline, and that's a big hit. And so I think that ultimately, trickles down to all parts of the portfolio. So even at the pre-seed. But as these guys said, we've seen rounds take longer to close. Founders not getting multiple offers and term sheets, but we're not really seeing price compression yet at the super early stage. And I think that's okay, actually. I mean, there were definitely some outliers. I mean, I think there were a lot of YC companies that were kind of coming out and raising at, 20 or 30 when they were really pre-seed. But where we focus, which is in the sub 10 million, it's like, as an investor, I say, does it really matter if I get in at a 5 million post or a 6 million post? At the end of the day, if we're investing in, potential outliers that can be billion-dollar companies, that's not going to make so much of a difference. So I think the compression just all along the stack has been a lot less at the early stage.
Yeah, and I think one topic that I want to tease out of that is the perhaps lesser or more liquidity in early stage investing, and hold that aside for just a moment. But what's weighing on people's minds is the big I word, inflation. The impact, Jenny, if any.
I'm not an economist, so I'm not sure. Honestly, there are all these factors. There's war, there's, inflation. I think there's a lot of hype. And so I think these are just multiple factors that are making the early stage harder. Many early stage companies are not just funded by VCs, but they're funded by many angels. And again, if you're, worried that, your properties aren't worth as much and your portfolio isn't worth as much, you're probably not going to be deploying as much cash.
Certainly, and to parse the early stage tranche or strata from others. Now we've established, right, that later stage funding, the multiples have compressed. You earlier just said that early stage hasn't quite come down yet. Are you predicting that early stage will follow suit, or do you think it's an outlier from an investment standpoint, Jenny?
Yeah, I think that venture in general is kind of lagging, and so we need a little bit more time to see. I think it will impact all areas of venture, but probably less at the pre-seed, and we've seen that actually historically as well. So I think prices will settle down. Some of the outlier prices that we were seeing, second-time founders were commanding just incredible prices for not much product, really just based on who they are. So maybe that will settle down a little bit, but I don't see any huge bottom dropping out of pre-seed and seed.
Certainly, and thanks for reassuring.
So good news, everyone.
Our nerds, Jenny fielding the ever optimist at the fund. And let's go back, Mag, to the report that you give to your portfolio companies. One thing that we talked about a little bit before we came out here, and I want to make sure that we bring it out, is some of the advice has started to change in terms of the duration of the amount of runway. Is that something that you could share?
So what our LPs want to hear is, how's the company doing? Are they growing? Are they meeting their budget? Do they have enough runway to get through this? Because nobody knows how long this shakeup is going to be. Is it going to be 6 months, 12 months, or 2 years? We don't know. So what our LPs want to know is, how much runway does the company have? Are they meeting their budget? If they're not meeting their budget and they raise at a really high valuation, are they cutting costs so they can increase runway? So we inform them of these specifics. And there's certain fundamentals and metrics that are important. So if you're adding 1 million new ARR this year and you're burning 3 for that new one, that makes no sense. The ARR burn ratio has to be around 1.5, below 2, if you're growing really fast, or if your customers are not buying your product as fast because of the downturn, and you're not growing 100%, if you had projected to grow 100% and you're now growing 50%, well, obviously, you need to do some layoffs. So all of these topics are important for my LPs.
Yeah, the big word we've seen a lot of my journalist cohort, Mariana Azevedo at TechCrunch, of course, you all read her A lot of layoffs in the news recently. Now we know some of the genesis of where that's coming from. Mag,
You're not meeting budget. Cut.
Mag with the hatchet. And just to clarify though, on how much runway should your portfolio companies have? What are you telling them?
It's not the same at the pre-seed, I don't think, that it is at seed and A and B. So if we're talking about seed here, it depends if you raised the round during the bubble and you got that 20, 30 forward-looking AR multiple, that was crazy. So we're going with 2.5 years minimum, because you may have to start raising a year in advance. So we just want to make sure that there's agility there, and there's the adjustment. There's time to make an adjustment if there's major changes in the growth potential and revenue traction. So we're hoping that our in the last round, by the way, the last rounds that were raised were massive rounds. Seed checks were now A checks. I don't know if you guys saw that shift in the last 3-4 years where seed rounds were so big compared to the years before. So they have a lot more capital.
It's
so
a different type of inflation,
yes,
Mag. It was a round inflation. Now we have
a round
price inflation.
But
yeah,
to your point,
we're going with 2.5.
I mean, to your point, founders were just used to raising every 12 months. Yeah, and so now to have 2.5 years of runway is just like a really
But this may change. I mean, if by the end of the year things are better and the war stops and there's no more talent problems and the inflation drops, then maybe we go back to massive growth and hiring, hiring faster. Maybe we go back to that.
All those things seem pretty probable to me.
Yeah. I hope so.
So, John, from your point of view, 30 days, all rays and sunshine, 30 days runway is sufficient. That's what I'm hearing.
Yeah. That's kind of what we're saying. We're going against the grain a little bit, but
You're going with 30 days of runway.
No, I'm kidding. I think the conventional wisdom is that at seed it does vary a little bit, and there's so many different parameters. Like when we're talking about valuations, if you still are able to raise a $5 million seed round, your valuation is going to be higher because you're just not going to take that much dilution. So we'll see what the round sizes look like, but I think 18 to 24 months is still kind of common. I think it used to be 12 to 18. Yeah. We were seeing companies raise in 6 to 12 months, and now I think it's going to be back to sort of the normal 18-month kind of time frames. So, again, if you're running a good company, like everybody said here, you're probably in okay shape. There's a lot of venture capital money out there. I think people need to realize, though, that also needs to consider how much reserves have been allocated, because just because there's a bunch of funds out there doesn't necessarily mean that it's available for new investments as much as it was 6 months ago. I think a lot of VCs are more conservative with their capital and with their reserves right now than they were. So there's a lot of dry powder, but it's not all available to everyone.
Right, certainly, and I think just to contrast some of the assurances that we've certainly gotten from Jenny on early stage, there is one cohort, right, late stage, if we could unpack that for the audience, that might see some trouble, John.
Yeah, I think the worst place to be right now is late stage, call it pre-IPO with a 30-day runway. That's not the place you want to be.
That's never a good place to be,
no, it's
though.
never
I mean,
a good place
come
to
on.
be. But even a 6-month runway right now doesn't look very good for, if your burn rate is really high and you're pretty late stage and you raised at a high valuation, the public market comps are pretty terrible right now. And so you're going to have your internal investors probably keep you alive, because you're not looking at new investors coming in unless they recap the company or take it down pretty far.
I mean, I think the but is like, if you're in a hot sector and the company's doing well, they're not having any issue. So I have 3 companies that just closed Series Bs at very attractive valuations, anywhere from 30 to 70 million in size. All got multiple term sheets. A few of them were announced, and some of them are not. But that happened really within the last month.
And what was the forward-looking AR multiple?
Healthy. I'd have to.
Higher than 10?
Yeah, for one of them.
Higher than 10?
Yeah. Yes.
Well, so thanks for sharing all these market signals. That's all the time that we have. My name is Jordan French, Grit Daily News, based in New York, covers a lot of startups. Big round of applause for Jenny Fielding with a fund. Stand up. Jon Soberg, MS&AD Ventures, and Mag Charbonneau, Inovia. Thanks for peeling back that curtain, sharing what's inside your heads. That's all the time that we have. Enjoy the rest of your collision. Until
Thank
next
you.
time.